Hello everyone, welcome to Pure Prime webinar today. And then we are going to start in 2 minutes. So be patient. We are going to wait for more people to join us first. Then we are going to start in 3 minutes. Thank you everyone for your support. And before we start, if you guys have any questions, you can also feel free to type in the chat box, which also ready for you guys. So, yep, you can ask any questions. We still have another 1 minute. All right, without further ado, we're going to start our webinar today. So for our topics that we are going to discuss today is regarding the market insight, which, one moment, yeah. So sorry. Okay, after today's webinar, you guys are going to understand what is the FOMC meeting, which is the Federal Reserve interest rates decisions, and then how can we use it to strategize our trading strategy, and then how can we how to understand further on how FOMC meeting can actually affect several trading products, like how FOMC meeting is going to affect dollar, gold, and other dollar related products. And then we are going to provide some forecasts on what can we expect from the FOMC meeting. So this is all the things that you are going to learn it today, because I think today we will have a very, very important events in the world. So for today, we are going to focus on the FOMC statement as well as the Federal Reserve letter. So we can expect there will be a significant movement for dollar as well as gold letter. So stay tuned on today's webinar. So before we start, we do want to make some risk disclaimer. So today's market insight webinar is only intended for educational and informational purpose only, and market participants shall not take it as financial or investment advice nor a trading signal. The accuracy and reliability of the information provided cannot be guaranteed. Pure Prime and I hosting the session are not liable for any losses or damage resulting from the use of the information presented. So just a very simple risk disclaimer for all of you. So without further ado, we are going to start our webinar now. So this is a topic that we are going to discuss today. First thing is about the monetary policy decisions. As you know, before we discuss the monetary policy decision, you guys need to have an understanding of the relationship between the interest rate as well as the exchange rate. Why monetary policy why monetary policy decisions are very, very important for trading strategy is because monetary policy will actually affect the interest rate, and then the interest rate is actually going to affect the movement of the foreign exchange. So I put it simple way is when the central bank decides to increase the interest rates aggressively, or if the interest rate increase more than the market expectations, then it will actually link positive. It will affect the currency positively. Like if they increase the interest rates, means that the currency will be high chance to be appreciated further. So this is the importance of the monetary policy. And if the Federal Reserve is going to not increase the currency or even decrease the interest rates, then this will actually cause the currency to depreciate more. So this is why it's very, very important for everyone. Interest rate and exchange rate, they are both correlated. So for today, we are going to focus on what the Federal Reserve is going to say. If the Fed is going to say that they are going to pause the interest rate after this month, then it will likely to cause the dollar to depreciate a lot, because lower interest rates, exchange rate will likely to drop further. And then we'll discuss more about what can we expect from the Federal Reserve. And then when the central bank decides to increase the interest rate or decrease the interest rate, we need to know why they want to do it. So how can we understand it? Like how can we determine whether the Fed is going to increase the rate or not to increase the rate? We need to focus on the economic data. Later, we will also look at the US economic data to understand whether the chance for the Federal Reserve to increase the rate or decrease the rate, which one will be higher. And then we will try to link the monetary policy decision, and then we link back to the asset movement. Like how can the interest rates affect the dollar movement? How can the interest rate affect the gold movement, and then as well as the oil market movement and equity market? So we're trying to talk about it later. Okay, so before we go through all the highlights today, you need to understand that high interest rates will link to higher foreign exchange rates, and low interest rate will actually cause the foreign exchange to drop. So this is the key thing today. So after you understand it, you can try to understand the chart as well as some fundamental later. Okay, so first topic, monetary policy decisions from the central bank. So why does the central bank want to increase the interest rate or not to increase the interest rate is because when do the central bank want to increase the interest rates? Is when the economy are in a recession, are very negative. So when economy are negative, the central bank will slowly and decide to lower the interest rate. Why they want to do it is because when economy are very, very bad, means nobody is going to spend their money. So low salary, low income, then no spending. If nobody is going to spend their money, lower spending will link to lower inflation, and then it will also link to lower GDP. Means it will cause the country become poorer, or the economic prospect for that country will become more negative. So in order for them to boost back the economy, right, they are going to lower the interest rate. So you need to imagine like this: when the central bank or when the Federal Reserve lower the interest rates, the borrowing cost should become lower already. Means that when you want to buy your car, you want to buy your house, it will be better for you to borrow money from bank with a lower interest rates, because low interest rate means lower cost of borrowing. So the Fed will decide to lower the interest rate in order to boost up the spending. So especially for economy in a recession situation. So this is an example, like during 2020, there are COVID-19 pandemic. And then you can also notice that the global central bank, right, is actually keep printing money, and then they decide to lower the interest rates. And if we take US as an example, right, the Federal Reserve decided to lower interest rate until 0 to 0.25%. A very, very low interest rate means you borrow from bank, the cost of borrowing are very, very low. So when we look at previously, the charts like 2020, after the central bank lowered the interest rate around here, you can notice that after the central bank lowered the interest rates, you can notice that overall trend for dollar dropped a lot. So this is a proof that the relationship between the interest rate as well as the exchange rates. So when they lower interest rates, overall currency drop, but end up after COVID-19's pandemics, the risk of the COVID become easing, and there are vaccine, then economic recovery become better and better. Then overall, then the Federal Reserve slowly and slowly starts to increase back the interest rate, and end up we can notice that overall trend for dollar appreciate a lot. So this is the thing. When 2021, the Fed starts to decide increase more interest rate until 2023, the interest rate is actually reached like 5 to 5.25%, a lot, from 0% increase until 5.25%. Why they want to increase the interest rate is because economy become better already, and then now we are experiencing a very hot inflation. Means because previously interest rates are low, a lot of people are going to spend money, they want to buy car, they want to buy house, they spend a lot. So when they spend a lot, right, goods and services or the things become more expensive. So when the things become more expensive due to the previous low interest rate environment, then the inflation starts to increase a lot. So inflation is actually bad also for the consumer around the world. So imagine if your salary increment might be 2% or 3%, but the goods and services that you want to buy reach until 10% or even 11% in future. So a lot of people is going to suffer, right? Because all the things become more expensive and more expensive. So as a central bank role, they want to stop it. They want to make the goods and services become cheaper and cheaper. So this is the time they want to increase back the interest rates. So when they increase back the interest rate, right, consumer spending will start lower because cost of borrowing increase, right? If you want to buy car, then due to high borrowing costs, you are not going to borrow a lot of money also. So you're not going to borrow a lot of money to buy car or buy house. It will discourage you to buy car or buy house due to high interest rates. So when you do not spend a lot, when people do not spend a lot, we can expect that inflation will starting to drop back because the price for goods and services will slowly drop back also. Okay, so this is the reason why the Fed starting to increase interest rate due to the high inflation environment that we are going to experience right now. So after the central bank decide to increase the interest rate, right, you can notice that overall trend for dollar, it increase until the peak around 2022. So when it reached 2022, is the time for Federal Reserve suddenly to saying that, okay, now the inflation might be slowly, it might be slowing down already. And then this is the time that the Federal Reserve might slow down the rate hike decisions, rate hike path. So when they understand our statement, dollar drop back. And then now we are currently experiencing the trend that the Federal Reserve might be increased their interest rate on the last time. Then after that, after the central bank increase the interest rate during the July meeting, then there will be a chance for the central bank to pause the interest rate decision, which is the whole tightening monetary policy cycle in 2023. There will be a chance for the Federal Reserve to pause all the tightening cycle. So later we'll focus on what the FOMC is going to say also. Okay, so I hope I give you guys understanding about what happens during the US market in last 3 years. What happens to their interest rate decisions, and then how can it affect the currency, and then so this is all the proof to the interest rate decisions and then the currency movement from 2020 during COVID time until today. So for today, we are going to focus on what the Federal Reserve is going to say now, and then what can we expect from the Fed. Okay, so currently, right, according to economics expectations, or even according to CME Fed Watch 2, CME Fed Watch 2 is considered as a voting from the market participant. They are trying to vote like how many percent of the market participant is going to expect that the Fed is going to increase by 25 basis points. So you can notice that actually 98% of probability of the investor or market participant are going to expect that the Fed is going to increase the interest rate, and then 2% expect the Fed is going to pause the interest rate or do not increase the interest rate. So high chance, like 98%, the Fed is going to increase by 25 basis points. So if you're going to look at the dollar charts, a lot of people might wonder, so if the Fed is going to increase the interest rates, means today dollars should be all go long, or go buy, or the gold you can consider all sell, right? You can consider like this, right? But actually no. So you can also notice that, right, it's worth to mention that after a lot of market participants actually expect the Federal Reserve is going to increase the interest rates by 25 basis points, you can notice that the dollar trend is actually trying to increase a lot already. So we can expect the 25 basis point is already priced in to the dollar market. So even, I put it more simple ways, even the Federal Reserve increase by 25 basis point, it might not continue to support the dollar to increase a lot. No, because market is already priced in. So you need to more aware of it, because 98% already think the Fed is going to increase the interest rate. So even the increase is still within the market expectation. But what you need to focus, or what you need to careful is you need to focus on what the Federal Reserve is going to say in future. Okay, so there are a lot of people start to forecast that, like 106 economists, especially from Reuters, they actually predict that this should be their last time to increase their interest rate already. This should be their last time to increase the tightening monetary policy, to implement their tightening monetary policy. What does this mean? It means that maybe the Federal Reserve is only going to increase the interest rate by this time 25 basis points. Then after that, they are going to pause it. This is most of the economists expect it. So if things really happens like this, right, we can expect the chance for dollar in long term should be dropped a lot if Federal Reserve really says something like that. Because once they increase the interest rate by 25 basis points, then after that, they're going to pause it or maintain a lower interest rate, means that prospect for dollar will start become more negative and negative. And this is also the reason why the long-term trend for dollar are very, very negative. But you need to bear in mind, this is the statement from the economists, but not the Federal Reserve. Whether the Federal Reserve is going to say something same with the economists or not are very difficult for us to forecast. But if we are going to only look at the economist perspective, we can expect that the Fed might provide a more dovish statement, like they increase the rate one last time, and after that, they're going to stop it. Then longer term trend for dollar should become much more negative, because if no more increase of interest rates, currency might be dropping also. So this is a thing from economists. But traders should bear in mind, because are very important from we need to focus on what the Federal Reserve is going to say later. You can expect there will be a huge movement. If the Fed suddenly says very hawkish or very dovish statement. So we'll stay tuned later. So this is the thing. And then I'm going to explain you guys about why we expect that longer term trend for dollar should become more negative. And then why a lot of economists is actually expect that the Fed is not going to increase the interest rate anymore in future or the later monetary policy meeting. Is because if you're going to look at the inflation data, you can notice that why they want to increase the interest rate is because they want to slow down the inflation, right? Previously, inflation too high, that's why they increase the interest rate. And then inflation starting to slow down, and then now reach 3%, almost same with the market Federal Reserve goal, which is 2%. So there will be a expectation that after the Fed increased by 25 basis points during later FOMC meeting, then the inflation should reach 2% already, like same with the Federal Reserve goal already. So there is no need for the Federal Reserve to continue increase the rate anymore lah. So this should be their last time. So people expect like this because inflation in US is actually slowing down aggressively. So you can expect that inflation slowing down, economy from US become not that good already, and then the Fed is not going to increase the interest rate anymore. The longer term trend for dollar should become much more negative. But there are criteria. Criteria is we need to make sure the Fed is really provided some dovish statement saying that inflation really slowing down already, and then in future Fed might slow down the rate hike decision. This is the statement that we need to hear from the Federal Reserve. But sometimes even a lot of economists saying things like Fed might slow down the inflation or slow down the interest rate decision or slow down the rate hike decision, but end up the Federal Reserve might provide another statement like our market expectations one. So this is the risk that you are going to take. That's why you need to be aware. Don't worry, later I will try to explain some technical analysis for you so you can have a better entry point or stop loss point for you to understand the Federal Reserve thing. Okay, especially after the FOMC meeting. So you can notice that in last month, the inflation is actually hitting like 2%. The reading also lower than the previous reading as well as the market forecast, which is the 3.1%. It's very good sign that US inflation has started to slowing down already. As I mentioned just now, slow down inflation will cause the Federal Reserve to pause the interest rate, then negative for dollar. So this is our expectations now. So we need to focus on what the Federal Reserve is going to say. So we are going to focus on a few market movement. If the Federal Reserve decides to not increase the interest rate anymore, or if the Federal Reserve going to provide some dovish statement, what will it have impact towards dollar as well as gold and then the equity market? What's the impact on it? So let's explain on the dollar first. So as I explained during the starting webinar, I've mentioned that if the central bank decides to increase the interest rates, then the currency will normally appreciate more. Why? I give you a good explanation or example. It's like you need to think interest rate as a deposit rate also, like the risk-free return from the central bank. So as a comparison, right, like if one country A, like for example, if US interest rates or the deposit rate is around 10%, or if compared to another country such as maybe Singapore, the interest rate is around 2%, it means that if you are going to save money in US bank, you are going to take a 10% return, like no risk one. You just save money in US bank, you get 10% return. You will save 1,000, you get 100 return from US central bank. But compared to Singapore, maybe if Singapore bank only offer you 2%, it means that if you save 1,000 in Singapore bank, you can only get $20. So when you get this kind of comparison, of course you are going to save in US bank, right? Because US offer you higher risk-free return, like return or the deposit rate. So this is the explanation. So when a lot of investors decide to save money in a higher interest rates country, actually their currency should be appreciated more, because maybe you are from Singapore, you need to convert your money from Sing dollar into the US dollar, then you're able to invest in US. You can only save money in USD, so you need to convert it. So when you sell Sing dollar and then you purchase dollar demand will increase, and then the price might be going up. So this is the thing, higher interest rates, higher currency, lower interest rates, lower currency value. So yeah, so this is the explanation for dollar. Then we are going to look at the dollar charts, and then we are going to look to it. Okay, so you can notice now, right, the because a lot of investors expect that the Fed is going to increase their interest rate by 25 basis points, then you can notice that overall trend for dollar slowly and slowly appreciate up. But after it hitting its crucial FIBO resistance 101.65, sorry, 101.20, it starts to retrace back. So it's already indicated that this should be a very strong resistance level, the FIBO resistance level, 101.20. For those who are not sure how can we draw the FIBO, it's actually like you click the F here in MT4, and then you click from the highest level, you draw until the lowest level. Then all the support and resistance will actually come out already. So this is the FIBO thing. So after you draw the FIBO, you can also get all the support and resistance, which is quite precise and valid also. So you can notice that due to the expectation of increased 25 basis point, overall trend for dollar to increase more, but after it hitting 101.220, it slowly dropped back. So indicated that this is a very strong resistance. And then what does the trader need to focus on now? We need to focus on the Fed statement. So if the Federal Reserve saying that in future they are not going to increase the rate anymore, if the Fed really says something like this, so we can expect that there will be a chance for dollar to drop a lot. Like if they say this should be the last time for increased interest rate already, the 25 basis point increment, and then in future there will be a lower interest rate, then we can expect that the long-term trend for dollar should become more negative and negative now. So if Fed is really say something like this, then you need to look at the technical analysis chart. You can draw an upward trend line over here, like H4, and draw an upward trend line over here. Then you can focus on this upward trend line and then the support level 100.75, this region. So if dollar candlestick successfully break below this crucial support level around here, you can expect that there will be a chance for dollar to continue to drop until 100.20. And then even if break below again, then we can expect that dollar should be dropping more. If the Fed really price some dovish statement and then dollar successfully break below the support level. Okay, so when you expect that if dollar drop, then normally if you expect dollar drop, you can consider to purchase gold or long gold. So if you're going to look at the gold chart, you can also notice that a lot of investors starting to price in already, even though the Fed haven't saying dovish statement. But a lot of investors starting to expect the Fed is going to say some dovish statement, or the Fed is going to say things like they are not going to increase the interest rate anymore in future. Then they react earlier, they purchase gold earlier. But this is all the speculation or the expectation only lah. But we need to make sure our signal are very precise, to make sure our trading strategy are very good. We really better for us to wait until to trade after the FOMC meeting. So better if you focus on the FOMC meeting, and then you can notice that this around 1985 should be a very strong resistance level around here. So if the Federal Reserve says some dovish statement, like saying that they are not going to increase the rate, then the chance for dollar will drop, and then there will be a chance for gold to break above the crucial resistance 1985. So this is the thing that you need to be careful on it. So FOMC meeting, dovish statement, and then gold really successfully break above 1985. Then it will enhance the chance for gold to continue extending its gain until 205. But you need to make sure on a few things. The Fed really need to provide some dovish statement, and the gold market should be really break out above the resistance level. Okay, so you need to bear in mind to it. And if the Federal Reserve provides some dovish, hawkish statement saying that currently they still expect the inflation are very, very high, they are starting to continue increase the interest rate in future, and this is not their last time to increase the interest rate, then there will be a chance for gold to slowly hit the double top, then drop back. So and reach until 1960. Nobody is going to successfully guessing that what the Federal Reserve is going to say. Even though all the economic data are very negative, and a high chance the Fed is going to provide some dovish statement, but this is not a 100% guarantee, because sometimes Federal Reserve will say something out of market expectation. So this is a thing that you need to bear in mind. So according to technical charts, you need to put a lot of stop loss. You need to be aware of it, because you can expect that the movement should be around 100 pip if the Fed says some aggressive statement. So you need to bear in mind. So I repeat, better or maybe safer strategy is you need to wait until the Federal Reserve statement, and then we need to look if the Fed going to say some dovish statement, then dollar is going to drop. Then we move back towards gold strategy. We need to make sure gold really will successfully break above 1985, because here will be a very strong resistance around here. So you need to be patient, and this is a safer strategy compared to you buy now, because if gold reach around here, right, and then even break above, right, you can easily set your stop loss or TP level. Your TP level maybe can around 2005, which can get you 140 pip. And then your stop loss level, you should just set below 1985 if you really reach around here. So your stop loss level should be around 60 only. It's quite worth also for your risk management strategy. But if the Federal Reserve provides our expectation thing, like provides some quite hawkish statement saying that they're going to increase the rate, then you can consider to short over here 1985, and then long term you should focus on the double top. And then your stop loss level should be set around above 1985. So this is a thing that you need to bear in mind, around maybe 1990. So if you compare your risk appetite, should be better. Your stop loss level is around 80, but if gold really reach here and then you short the position, your profit should be around 230. Okay, so this is a thing that you need to be careful. So we cannot guarantee that FOMC meeting will cause the gold to go up or go down. It's very, very, very difficult for us to forecast. So what can we do now is we need to focus on their statement first to make sure what they are going to say. And then after they say something, then you look at the market trend and then you strategize it. But for short term, it should be hitting the double top. There will be a chance for gold to hitting a double top until 1985. And then during the FOMC meeting, this should be the crucial level to decide whether it will break out or drop back. Okay, but there will also a chance for gold to break below 1960 and then consider sell. So all the resistance support you need to draw nicely and then set your stop loss and TP level better nicely. But for new trader, I really don't recommend you guys to trade during the FOMC or after FOMC. But you can try to understand the FOMC news. Like if the Fed says some hawkish statement, then what is the reactions for dollar and what is the reaction for gold? We can take it as experience. But if they say hawkish statement, then dollar will go up, gold might go down. If they say dovish statement, then just vice versa. Okay, so this is a trading strategy for you guys. Then we're going to look at other products such as USD JPY also. So you can also notice that overall trend for USD JPY is also quite negative because USD JPY can consider one of the major highest volatility products in the market. So if you don't want to trade gold, you can also consider to trade with USD JPY. If the Fed is not going to increase the rate, and then they really provide some dovish statement, then usually you can focus on 140.25, a strong support level over here. It's quite nice also. So one is break below, higher chance for UJ to drop maybe until 1920. So this is the thing. And then for US equity market, you can try to link a bit towards the US equity market. So a lot of people might be curious why high interest rates US equity market will drop or low interest rate will actually affect the US equity market. So if traders don't want to trade gold or dollar related product, you can also understand for the US equity market. So I put it a very simple way. So if the Fed is going to increase the interest rates, high chance that US equity market will drop aggressively, will drop back. So why does this thing happen? Is because when the Federal Reserve increase the interest rate, right? If you are a high technology company, like if you are Apple, if you are Facebook, some high technology company, you are going to borrow a lot of money to build your innovative product, right? You need to spend a lot in R&D things. But if the Fed going to increase the interest rates, means that your borrowing cost is going to increase, your interest expenses is also going to increase, which will be negatively affect your value of the company also. So put in more simple way, high interest rates or high interest in longer term, US equity market will drop also. But vice versa, if the Fed is going to say that they are going to pause the rate hike, then US equity market should become positive in future. But what can be sure now is the Fed will be high chance to increase the interest rate by 25 basis points. So this is a thing that you need to take note. High chance, 98% of probability. The expectation is from the voting is from market participants at 25 basis points. So this is already a sure thing. But what we need to focus is FOMC statement. So FOMC statement are very, very important to decide whether they are going to increase more or decrease more in longer term basis. So bear in mind, interest decision is not most important. What is the most important thing is their statement. What are they going to say later? Okay. So yeah, I hope I make you guys understand about what will be happening later. Then now open for Q&A sessions. Do you guys have any questions want to ask me? If the webinar are unclear or you need me to clarify something, you can also feel free to type in the chat box. So hello everyone, I saw a lot of people saying hello to me. Hello, thank you for your support for Q Prime webinar. Any questions want me to clarify, like any explanation that are unclear and you need me to explain it again? Maybe some trading strategy on the product that you are interested to, you can also type in the chat box to let me know. Thank you everyone for your support once again. For new trader, right, I really don't recommend you to do some full margin trading during the FOMC meeting, high risk. So because the movement should be around 100 pip, you need to be careful also for new trader. Any questions? Much interest in gold. Okay, so for gold market, right, today you might consider like a double top here, and then after the FOMC meeting, you need to decide whether the gold is successfully break above 1985. If it's really successfully break above, and then if the Federal Reserve really saying that they are not going to increase the interest rate anymore in future, then there will be a chance for gold to continue going up more. But if you want to trade now, right, high risk up, because we are not sure what the Federal Reserve is going to say. High risk, but you want to safer investment, maybe you can wait until it break above 1985. And then I think when it break above, right, is when it's actually the Federal Reserve is actually provide some hawkish statement, dovish statement already. The Fed might be starting to saying that they are not going to increase the interest rate anymore. So, and then if they're setting like that and then go break above 1985, then it should be a good chance for it to extend its gain until 2005. But okay lah, because why we can consider trade like this is because the risk management is nicer. Because you can notice that your stop loss level can put just below 185, and then your TP level can reach until next resistance, which can get you 150 pips profit. But if the Fed is going to say maybe some hawkish statement, then dollar is going up, then there will be a chance for gold to drop back up. So maybe double top. You can sell when it reach 1985 also. Safer also, because if you sell, if the Fed going to price some hawkish statement, then your stop loss level, same thing, just a little bit only, but your TP level huge until 1960. Okay, I hope I answer your question for Ibrahim. And then got people ask, what's the best time frame and why? It depends on what types of trading strategy you are going to use it. But for my advice, I think scalping should be better because long-term trading should be better. So like maybe you can consider to use H4 or day one should be better, because if you are going to use short time frame like H1, M30, it's not bad lah, but a lot of this should be a higher volatility, because for example, right, if you use a very short time frame, right, it will affect by a lot of uncertainty things. For example, if suddenly a lot of people going to US and travel, and then if you are going to use like maybe M1, H1, you will get lost because suddenly a lot of people travel to US, then they are going to purchase the US dollar, and then in M5, you notice that it will slowly increase a lot. Then if you use M5 to trade, you will lose, because this is a thing that you unpredictable. You are not able to predict when there will be people travel to US, or when there will be a lot of small things happen in US. So shorter time frame will affect by a lot of this kind of small volatility things, the volatilities of this thing. But if you use longer term time frame like H4 or day one, there are a few benefits. One of the benefits is you don't have to keep looking at the charts and nervous every like 5 minutes or 10 minutes. You don't have to keep looking at it. Maybe you just use the H4 4-hour candlestick, and then you can just trade in 4-hour thing, or maybe day trader. Or maybe you can use the day one. So you don't have to nervous also like H4 or day one. You want the candlestick to break above, right? Maybe you need to wait like 1 day. So one day after it's break above, then you can consider your buy or maybe the sell order, and you can wait for the longer term. So the thing is you can stress free a bit if you use longer term. And then the second benefit is you can avoid some small uncertainty things. Okay, I hope I answered the question also for Kedah. Any more questions? Because trading linked to emotion, like if you use a very short time frame, like M5, 15 minutes, it's not, some people like it lah, but it will trigger your emotion. You cannot focus on other things, you just look at the chart only. But compare you use H4 day one or even weekly, you put one order and then you do a day trade. You make sure your margin level are enough and then it should be good also. It can help better your emotion. You don't have to get nervous like in every 5 minutes. But some people like this kind of feeling, then maybe you can go through scalping like 5-minute, 15-minute charts to experience it. Okay, done. Any more questions that you need me to answer? Thank you so much once again for your support. And what about indicator? You advise if you are going to use actually you can also use the Pure Prime website. In Pure Prime website, right, we actually provide some charts for client also. So I will explain about a few indicators from Pure Prime. Normally, analysts from Pure Prime is actually will using something like MACD and RSI. So I give you example. One moment, yeah. And then if you are very interested to indicator things like trading strategy, right? Maybe we will also launch another webinar that talk more about the trading strategy. Later you can give some comment on there. But in Pure Prime, you can actually look at the website. Maybe I give you one example. You can notice that all the charts over here, we will write out the resistance and support level, and then we will use the RSI and MACD to determine how can we use it to do the trading strategy. And then where can I watch Federal Reserve news? One thing is you can also watch at the Pure Prime website, market analyst website tomorrow, and we'll update it tomorrow. Or if you want to have a live update, you can go through the Forex Factory. So you can go through the Forex Factory and then you click the news. Normally, Forex Factory, the news come out should be quite fast also. So this is the thing that you can focus on, the news. So I think after the GMT plus 3 time, 9 p.m. After 9 p.m. GMT plus 3, Forex Factory will release the result over here. So you can focus on it. Forex Factory is quite not bad for trader. And then Christopher asked, how much percentage of risk can I take per trade? It depends on your own risk appetite. Some people, even they lost like $1,000, they have no feeling. Then the risk they need to take should be higher. Risk, how much of risk needs to determine by your own self. Like your comfortable risk that you are going to take. You cannot follow others. Like I say, maybe your risk appetite should be like you set 100 pip also never mind. But for your own self, 100 pip you should consider very huge already. Then you don't follow my risk appetite. So for Christopher questions, how much percent of risk, it really depends on your own emotion. For trading, right, it's better for you to have your own trading strategy that suit your emotion. Like if you think your like all of your trade, like you do 1 lot, 2 lot, it will affect every minute of your emotion, then it means that you need to lower your risk already. You cannot take that much of percentage of risk that you need to experience already. You need to lower it. So you need to lower your lot size. Like better for you to don't the risk is you better don't like include your emotion into the trading strategy. So the risk is determined by your own emotion. You need to find your suitable risk that don't affect your emotion mostly. So this should be the risk appetite that you need to do per trade. Like comfortable trading. It's not like every 5 minutes you look at the chart and then, oh, I'm going to stop out or not. No. So this is not a very good trading strategy. Okay. I hope I answered your question also, Christopher. Yep. So don't follow like others people like saying that how much risk you are going to take. You need to understand your own risk appetite that you're really comfortable to it. I hope I answer your questions also. Yep. But better risk management is maybe you can consider like where you need to TP, where you need to stop loss. Your TP level, your take profit level, your profit should be much higher than the stop loss level. For example, right, if you are going to long go now, should be a good thing. But if you are going to look at the risk appetite, it's not recommended, because if you long go, your profit should be around 90 and then it reach the resistance level around here, then your risk should be higher already. But your stop loss level maybe 100 pip, so your risk should be higher. It's not recommended, but some people like to trade it because they enjoy. But if you wait until the goal increase until here, like resistance level around here, 1985, you know, if the goal successfully break above the resistance, then it might increase more. So your stop loss level is clearer. You can just set your stop loss level below 1985, like maybe 1975 or 1980. So when you compare, right, your stop loss level should around 60, but your TP level after gold break out above should be around 140 or 150. So this should be the better risk management for you. But how much position that you need to open is really depends on your own emotion. You better don't affect by it a lot. So you're really nervous about your trade, then lower the position size until you're really comfortable to it. For Christopher, more questions for others? I really hope I answer your questions and helping you in your future trading strategy. If no more questions, then we are going to end here. I hope the webinar tonight will provide some helpful insight. Thank you everyone once again for your support. So if no more questions, we are going to end here. Thank you. Have a nice day and good luck for your trading strategy. Or some people ask, one thing I learned in trading when you start is to be patient and make profit in more 1 year. Sorry, before we end, Kada actually asked one question. Need to be patient and make profit in more 1 year. Depends, like if you want to hold long term, right, you better hold in stock market, because if you want to hold long term in Forex, it can, but it might charge you some swap fee that you need to be aware also. But trading should, the most important in trading is you need to have your own emotion, because winning are never enough one. You win more, you win once. If you cannot control emotion, you will try to open a bigger position. You want to try to win more, and then there will be a chance for you to, like, you lost one time, everything you win before you become nothing. So emotion are very important. Compared to all those fundamental, the technical analysis, that if you cannot control your own emotion, it's very difficult. So I hope you guys learn the lesson, because yeah. Thank you. We will definitely conduct more webinars in future. And once again, thank you all for your support. If no more questions, then we are going to end now. Thank you, everyone. Good day. Good luck for your trading later. Thank you once again for all your support. Thank you. Appreciate it. So goodbye, everyone.